Good morning, everyone, and welcome to this webinar where we'll present our annual cross-border distribution of investment funds study. Before we begin, please note that this webinar is being recorded and will be made available on our ALFI member collaboration hub for those who do not get a chance to see it today. I'm delighted to welcome Ralph Williams. Ralph is a Director EMEA Insights at Broadridge. Before we dive into the key findings of the study, Ralph, could you briefly walk us through the research methodology and also share what types of data and sources were used to support the analysis and study?
Thank you, Brita. Good morning, everyone. So both the report and the slides we're going to see today rely on Broadridge data throughout, chiefly our global market intelligence funds database, which tracks assets and flows for over 110,000 investment products. More specifically, the numbers you'll see combine our asset management consortium data. So this is groups sending real reported data covering about 70% of the cross-border marketplace with estimated net flows data to fill the gap. And we do rely also on estimates for anything that's fund or group level data just to preserve manager anonymity. In addition, in some places, we're going to use our fund buyer focus data. So this is quantitative and qualitative data based on around 1,300 interviews a year with fund selectors throughout Europe, APAC, and the US. And this is going to be the source of some interesting insights into things like preferred asset management brands or future asset allocation intentions. So we'll cover some of that today in the slides.
Excellent. Thank you very much, Ralph. So let's get started. In terms of the study, can you give us an overview of today's cross-border distribution landscape and share how you see it evolving?
Yeah, so I'm going to start with a number, which is 8.5 trillion euros. And that's where the cross-border fund market stands today. It's a new record and a sign of just how significant the market is for managers everywhere. We are just a year on from the previous report, and naturally the cross-border landscape looks similar in many regards, at least in its outlines. Of course, the constant here is change as the cross-border model continues not just to scale, but to globalize and reach new frontiers. That said, any conversation has to start really with this first slide. It has to start with Europe, as cross-border funds have very deep roots, obviously, in European soil, and Europe remains the number one market by a long stretch. So we're just looking at cumulative net sales here. In the last 5 years alone, European investors have directed over 900 billion euros into cross-border funds. So understandably, Europe is that market that most product, marketing, sales people have in mind when they conceive a cross-border strategy, because this is where both the infrastructure and the investment bases are found to turn a good fund into a scalable business. But as I possibly hinted, European investors aren't the only ones buying cross-border funds. We're now looking at a record 16% of assets coming from outside Europe's borders. So that's over 1.3 trillion euros in capital, driven really by the credibility of UCITS, but also increasingly Europe's ETF infrastructure. If you can make sense of this pie chart, the dark blue here is APAC, and that's our second largest market in absolute terms. It's about 11% of cross-border assets today. And APAC's also seen 185 billion euros in net flow since 2020, so not insignificant. That said, it is the smaller markets here on our right-hand chart, I'm thinking Latin America on 21% and Middle East and Asia on 23%, that these are the fastest growing markets. They really showcase the story of UCITS global pull. And this is market penetration, so the share of the local market that is cross-border and domestic. So Latin America, MEA, this is where the picture is changing fastest, as we can also see on this, this next slide. In reality, they've seen respectively 5% and 6%, sorry, not percent, percentage point increases in market penetration just since the last report. So this really does suggest that there's untapped opportunity in emerging distribution markets. The UCITS brand does travel very well precisely because it solves a problem. How do you give investors access to diversified, professionally managed strategies in jurisdictions where, well, local infrastructure can't yet deliver that at scale? And I was going to pass fairly quickly on this slide, but before the call, Brita, you were asking what the top markets were here. For Middle East and Africa, it's actually Israel and the UAE. And for Latin America, the top spot goes to US offshore, so more of a OPAC bucket of island markets, followed by Chile and Mexico, which may ring a bell for some people.
Excellent. Thank you very much, Ralph. Now, you mentioned several key markets and regions, but not the US. Yet we see it appear in the report. The US is not typically viewed as a cross-border hub, in my view, but could you tell us a little bit more about that?
Absolutely. So I felt like we couldn't not talk about America for a couple of reasons, but it comes down to the world's largest investment market is increasingly dominating the cross-border story. So this is a slide that actually very similar to one we saw last year and a similar point, but although Europeans created the cross-border playing field, it really has been dominated, the league has been dominated by American teams. So right now, US groups control 54% of the cross-border market. So that's groups headquartered in the US. And to put that into perspective, the second largest market, the UK, is on just 11%, 10% for France. It's also quite obvious when you look at the individual firm level on the right here. BlackRock alone holds nearly 1.4 trillion in assets, which is nearly practically 3 times as much as its nearest competitor, Amundi. And if you take all of those top 10 largest cross-border managers, 6 are American. So we're back to this fascinating paradox where Europe built the regulatory framework and provides the capital. You over there in Luxembourg run a big chunk of the operational plumbing, and yet the most successful firms are overwhelmingly American. So cross-border is in some ways the land of opportunity, open to all and built on European principles. But we see that it's really those US managers with their scale, their brand recognition and their ambition who have pushed that frontier furthest. Now, America, as you say, I mean, it's not necessarily associated with cross-border activity. They're not an obvious buyer of foreign funds, but there's something new in this year's data that flips the narrative slightly, and it's a change we've made at Broadridge, but we're now able to see foreign buying of American funds, or more specifically, American ETFs. So it may not look like traditional passported distribution, but it is still cross-border activity. And this is something we're able to see because Broadridge has extensive proxy data in the US, and we can really drill down to the end buyer in those cases. So what the data shows here is that typically APAC and Europe are the biggest outside buyers of American funds. you will see North America here. And just in case you were wondering, that is not Americans buying their own funds. That is, of course, Canada. So we think this adds a new dimension to the cross-border story, one where it's not just about European domiciled funds traveling outward, but also about capital flowing in to the US from abroad. And I think this is very valuable data for ETF providers in Europe or APAC, as it means that they can factor this in properly. They can quantify the extent of that line of competition when it comes to ETFs.
Very interesting. Thank you, Ralph. Now, if we move on throughout the report, there is some information about the key challenges that cross-border managers are facing today. What are they?
I've said, I think, quite a lot of positive things in these initial slides, but I do want to highlight just how much competitive pressure is reshaping the industry. I'm just going to start with this left-hand chart here, which shows the total number of managers mentioned as a most used provider by fund selectors in Europe over the past few years. So this is an output from those intermediary interviews, and it shows a pretty dramatic fall. This chart is highlighting that fewer managers are making the cut as a key supplier with the deep, locked in and really valuable relationship that entails. There's other data. If I was to cite the average number of providers used by distributors, that's also down, more stable, but down over the past couple of years by a couple of points and by much more over the decade. So the takeaway is that selectors are becoming more discerning in the relationships they build. This right-hand chart puts some numbers directly on the supply side. The number of cross-border managers has shrunk every year for the last 5 years. And meanwhile, asset concentration has shot up from 43% in 2020 to 51% now. So we're seeing a fast shrinking middle ground. I'm not going to shock anyone. Passive uptake is reshaping industry economics, and we'll go into that a little bit later on. But as I say, selectors are also choosing to develop fewer relationships with managers, and that makes all selection and upsell harder. Looking at some more of this data, and this is quite logical, but managers are facing a more critical buying environment. I've hinted at that already. What our selector data suggests when we look at fund selection criteria is that Europe's competitive pressure is now primarily a quality plus pricing story. So selector behavior is becoming more hard-nosed, with buyers concentrating on core fundamentals like quality, price, and provider strength. So we're seeing the space for kind of softer differentiators is shrinking a bit. Service may be an exception to that rule. And by the way, we're not looking at the full spectrum of selection criteria today. This is a conscious choice that I chose to make some points. And those are really that quality is decisive. So that's 38% of selectors currently mentioning quality of management team as their top selection criteria. Secondly, pricing pressure has intensified dramatically. It's gone up from 19% to 34% 19 to 34% of selectors mentioning it as a criteria since 2020. And thirdly, as I said, differentiators are narrowing. So if you take ESG, for example, that was up at 17% in 2024, mentioned in 17% of interviews. Now it's just 11%. Product range, is also down from its peak. So in other words, the factors that used to set managers apart, the things you could lean on to win assets, other than price and performance, are losing some of their edge. I will just linger if I can, thank you. If I can change slide, I'm sorry, that's the computer at my end, I want to linger a little bit on pricing because I think it's the single most important trend here. Fee sensitivity among fund selectors has grown faster than any other criteria since 2020. And this isn't happening in isolation. It reflects broader structural forces, the rise of passive and ETFs, and relentless fee compression across the industry. And I think it's important to realize that those forces are reshaping what selectors expect as a baseline, and as a kind of, it's generating snowballing pressure as that goes along. The baseline then creates its own new pressure. And the effect, as we see, is that the environment increasingly favors low-cost, high-quality managers. This right-hand chart is looking at passive and active ETF sales versus all other sales, cumulative, and it says quite a lot. So you're no longer able to justify fees today, I think, with performance alone. You really need to explain why your pricing makes sense relative to the alternatives, because we know that selectors are asking questions here earlier and more often than ever before. Final pressure point to be aware of is actually a weakening product development pipeline. So over the long term, cross-border funds have typically accounted for about 70% of European asset raising, that is, flows to new launches. But of late, that figure over the latest years has fallen to just 55%. So still a majority for cross-border, but a lesser share of total net new money. And there's something fairly clear behind that. It's solutions. We've seen that domestic markets have seen a surge in target maturity funds, guaranteed products, capital protected structures. So all fund types that tend to be manufactured and distributed locally. And these have been pulling a growing share of new launch sales into the domestic column. But there is a counterpoint, which is that increasingly cross-border is entering certainly the target maturity market itself. These funds in the markets where they're sold most, such as Italy and Spain in Europe, although they're also sold obviously in APAC, they have very high levels of recognition, and cross-border managers are making the most of that to launch their own products, even without captive distribution. So target maturity was the third highest raising sector, so raising via new funds in the year to Q1 2026. And cross-border's also a hub of innovation. We're seeing increasing experimentation with more innovative forms of solution, such as step-in funds and buffer funds. Those are recent examples, particularly in 2026.
Thank you, Ralph. Now, you've already touched a little bit on some of the trends that we've seen, but if we explore this a little bit further, what other investment trends are shaping the cross-border distribution landscape today and maybe also in the years to come?
I'll kick off with private markets because it remains quite a popular topic. That said, what you will have noticed if you read the financial press is that there's been no shortage of fairly negative headlines over the last year or so, since early 2025. There's been talk of surging redemption requests and gating, debate about potentially offloading risk to retail investors as the sector has democratized, tech exposure concerns at times, and of course, geopolitical uncertainty. So it has been a bit of a whirlwind for private assets. And while the nature of private assets makes sales data quite hard to come by, what we know from our selector interviews is that appetite has fallen, but it's also held up more than you might expect. It's held up more than I would have expected. So these two charts are showing allocation intentions along with the rank. So that's a rank out of 24 sectors that we track in Europe, we calculate a net number based on the share of interviewees who want to increase or decrease their allocations to private markets over the coming 12 months. And the interesting thing here is that private equity on the left, it's still a top 10 allocation sector as of Q1 2026, even if down, and private debt down further, but also still in positive territory in terms of those intentions, those future asset allocation intentions. So selectors aren't ready to pull the plug here yet. One of what I think are the key trends that we've seen play out throughout 2025 and that we're going to continue to see in 2026 is the diversification away from US assets. Initially, this came in the form of lower inflows. So we're looking at the 2025 data here, which is of course what we've got in the report as well. But for full disclosure, we've seen this really speed up in 2026. In the first quarter alone, 21 billion euros flowed out of US focused sectors in the cross-border space. So that's across both bonds and equities. Equities did bear the brunt though. And we know really that reduced US exposure is increasingly being sought or activated in reaction to fairly unpredictable policy and slightly pricey markets. And this opens up quite an opportunity for other equity geographies and sectors. On the right-hand chart here, we're looking at a number of the best-selling sectors over 2025, and we see equities Europe, emerging markets, equities Euroland really bubbling up. So emerging markets in Europe have been some of the prime beneficiaries from those falling US allocations. But what I would say here is that there's really a competitive angle to highlight because the US giants have built their cross-border lead, in particular on passive US equity exposure. So in a world where investors are diversifying away from the passive, heavy US-centric playbook, well, in that world, European and other managers with local expertise and active credentials can probably compete on slightly more level ground. The theme that we certainly can't bypass today, I say theme, another trend is in fact a theme, is the rise of defense funds. Generally speaking, since the pandemic, thematic fund sales have cratered. This is the majority of thematic sectors, this line that practically falls off the chart here. There's been very few exceptions, but the upcoming defense theme is one of them. Now, I'm talking about defense here. This is actually incorporated in Broadridge data within a broader security and space sector. And that captures everything from sort of pure play defense funds to blended funds, cybersecurity, strategic autonomy products, space products, and all of these are actually related industries in terms of the technologies. Space quite topical right now, but also marginal. There are very few of these funds. So essentially this sector still boils down to defense. AUM here has more than doubled in the last 2 years to 33 billion, and it is now a top 10 seller in the cross-border space. So investors, the reason this is enjoying quite so much success is because it's not seen so much as a cyclical theme, but as a more structural allocation. So whether that's NATO spending commitments or Europe's various rearmament programs, or just broad kind of cybersecurity and space infrastructure needs, investors believe it's a theme strongly backed by government policy, a bit like ESG in the early days. It's got a regulatory and policy tailwind behind it. So throughout 2025, ETFs captured the lion's share here. It was a very concentrated space. This was something we were warning about. But 2026 has been very interesting. We've seen quite a big wave of actively managed products in the form of strategic autonomy funds hitting shelves. So the landscape here is quite quickly broadening beyond just passive. Just a quick remark that may surprise some of you. We are seeing about 15 billion euros of Article 8 classified products within the security space. And a few years ago, that would have probably been unthinkable, but the narrative has shifted. We're in a world where security is increasingly being framed as a social good, protecting democratic values, ensuring energy independence, safeguarding critical infrastructure, and so on. And so we've got this interesting phenomenon where the S in security and the S in ESG are converging. This is a trend that I'm talking about in a cross-border context, but it's very much a European-centric phenomenon, I would add. These funds have been especially popular in Nordic markets where societal preparedness is prioritized and understood. Also, I think in Germany, thanks to the Zeitenwende with unprecedented arms infrastructure spending, plus the fact that a lot of local champions stand to benefit, or some local champions stand to benefit from this spending. So for managers with credible capabilities here, this is an opportunity to find a space where thematic momentum, geopolitical tailwinds, and ESG compatibility all sort of point in the same direction. And finally, backed by popular demand, a quick update on active ETFs. So last year, I described this as a one-horse race dominated really by JP Morgan, or by a handful of managers. And if you look at the top four, the top group, next three, top four managers at the end of 2024, they still held 83% of all active ETF AUM in the cross-border space. The good news is that the game is really opening up and quite fast. Concentration has dropped meaningfully. More managers are entering the space, and it's really starting to broaden. So that's a positive development for the segment as a whole. Just on the flip side, one issue is that at an individual fund level, we are looking at a lot of inefficient products. So as of Q1 2026, 56%, more than half of active ETFs did hold less than 100 million euros in AUM. So we've got a fairly crowded field. We know that that's fairly, the inefficiency is fairly strongly correlated with failure over the long term. So it remains a space to watch. I think as time goes by, these numbers are going to settle and it's going to look healthier. And as I say, more managers, overall the opportunity is certainly less concentrated for the majority of players. But bear in mind, we mentioned the US earlier, that this is also a space, active ETFs in particular, more than passive, where a lot of competition comes directly from America. And we do see even the fund selectors we talk to who are clearly buying products straight off US exchanges while describing their perfect active ETF and skipping Europe entirely. So something to be aware of. This is where I will stop for today, because we're also going to take some questions. While we do that, I will just share this slide with a QR code that you can use your phones to go and find the full report and download it or read it online.
Thank you so much, Ralph. Very interesting summary of the study and its key findings. As you mentioned, we actually did receive a number of questions from the audience, so thank you very much for that. Some of the questions were covered throughout your presentation around the trends and challenges. Now, we also did receive some questions on regulatory topics or digitalization and tokenization, which again, just to clarify, we're not going to cover here. It's really the aim of this webinar is to present the cross-border distribution landscape, the facts and the findings and the figures. However, we've picked a question that we found quite interesting from someone in the audience that I would like to read out to you, Ralph, and for you to answer. The question is, in a market increasingly dominated by mega funds and ETF growth that you just mentioned there, what are the most effective ways for active managers to maintain pricing power and secure shelf space in cross-border distribution platforms?
Well, as you say, I think hopefully what we've just discussed gives us a pretty clear framework to answer this question. I'll start by repeating that you can't avoid the pricing conversation today. As I said, it's the fastest growing selection criteria. So you really need to have a defensible pricing narrative and to be able to explain how you fit in and why. And it's not about pricing alone. We also saw that quality of investment team today is primordial. So there's a combination to achieve, and perhaps miss one, miss the other, you're going to be screened out. Beyond that, more explicitly, I would answer three things. Firstly, exploit the rotation. So we saw that, and this is speeding up, investors are turning their back on US exposure, and that happens to be mostly passive leaning. So this is an opportunity. It's possibly the most significant competitive opening for some time for active managers just to do more business. Second, go where active is truly winning. So there are a number of sectors that you can be thinking about. Security and defense is one through those strategic autonomy funds, which are popular right now. Global equities, despite being massive on the passive side, is also the biggest sector for active flows and has been for some time. So don't neglect this, especially in an uncertain world. It's a space where active managers can shine. If we think a little bit wider, mixed assets, especially in APAC, remain an opportunity. And the main thing not to forget is that most sectors in outflow, and you'll see the numbers and they can look scary, most sectors in outflow still have a fairly significant number of stronger funds that are winning assets at others' expense. So there is a rotation from active to passive, but there's also another important rotation that you want to be on the right side of, and that's from active to active. And last but not least, this is something that came up last year, but you want to invest in service partnerships. So our selector interviews consistently show that service-based criteria play a big role in selection, and that closer relationships with a smaller number of managers is the trend. So you want to be one of that number. And mid-tier active managers can really differentiate here against the mega platforms with your service levels. If your clients are your partners, they are more likely both to give you shelf space, but also to stick with you in times of uncertainty or underperformance.
Thank you very much, Ralph. Now, I'm looking at the time. I think we're still okay. Would it be okay if I squeezed in a very last question?
Sure, let's go for it.
Okay, so I'll pick another question that we received from the audience, and that is, where do you see genuine localization of demand in APAC and MEA? We mentioned that those regions earlier on. And what are the key barriers to scaling UCITS distribution beyond early adopter segments?
So just off the top of my head, in APAC, the clearest localized demand signal is mixed assets, which is again something we actually covered in more detail last year, but that's a genuine localization of preference. It's been very strong and for a very long time. And it does matter commercially because mixed assets carry obviously higher fees than some of the passive products dominating in Europe, but also that demand has really been sustained. It hasn't seen the same level of net withdrawals that we saw for many years in Europe when it came to mixed assets. In APAC, they continue to buy mixed funds. In terms of barriers still on APAC here, the obvious one is churn, because we see that APAC buyers have very different habits when it comes to holding funds. They tend to swap a lot more often and faster, and that does make it a little bit harder to build stable AUM because there's a lot of chasing of trends. And then there's hub dependency, because despite the big populations in parts of Asia, distribution infrastructure hasn't really opened up much beyond those sort of key hubs for UCITS, Hong Kong, Singapore, Taiwan. And penetrating those other markets is going to require, changing regulation and maybe local partnership models. These exist to an extent, but they've yet to come to fruition. In MEA, the story is a bit different. We mentioned a couple of markets for MEA and for APAC that are sort of the biggest sources of demand for cross-border funds. But the key point here is that those local fund ecosystems aren't that developed, and UCITS fills a gap with credibility and investor protection that local infrastructure can't yet deliver. So the barrier when it comes to MEA isn't demand, it's commitment. Because I say it isn't demand, there's some very rich markets, but they're complex and they may require more of a on-the-ground presence. And again, local partnerships and some patience. The penetration numbers that we've seen really tell you that the opportunity is real and expanding, but the white space won't fill itself. So these markets do require effort to crack. I think that's it for me. And
thank you
I'll pass back to you, Britta.
Yes, thank you so much, Ralph. Very interesting. So on that note, first of all, thank you, Ralph, for today's presentation of our study and the key facts and findings. Also, a big thank you to the Broadridge team on the efforts that go into making this study. And on that note, I would also like to thank the audience for tuning in, and we hope you will join us again next year for our next edition. Thank you very much, and bye-bye. Have a good day.
Bye.